The Federal Reserve just ran out of options, and they don't want you to know it. Right now, in the marble halls of the Eccles Building in Washington, the most powerful financial institution on Earth is quietly facing a reality that contradicts everything they've told us for decades. The tools that saved the economy in 2008, that tamed inflation in the 1980s, that built the modern financial system, they're broken. And what comes next will redefine money itself. For 70 years, the Federal Reserve operated with a simple promise. When the economy overheats, we raise interest rates to cool it down. When it collapses, we lower rates to revive it. It was elegant. It was predictable. It was the invisible hand that kept capitalism from eating itself alive. During the Great Inflation of the 1970s, Fed Chairman Paul Volcker raised rates to 20%. Devastating, yes, but it worked. Inflation died. The economy reset. In 2008, when the financial system was hours from total collapse, the Fed dropped rates to zero and flooded the market with trillions in fresh liquidity. Markets roared back. Unemployment fell. The textbooks were right, but something changed. Something fundamental, and the people at the top realized it too late. Look at what happened in 2022. Inflation hit levels not seen in 40 years. The Fed responded exactly as they were supposed to. They raised rates aggressively, the fastest pace in modern history. 11 rate hikes, from near zero to over 5% in less than 18 months. By every historical measure, this should have crushed inflation. It should have cooled the economy. It should have worked, but inflation didn't collapse. It lingered. It mutated. It became sticky in ways the models never predicted. Housing costs kept rising. Wages kept climbing. Consumer spending barely flinched. The old rules didn't apply anymore. Why? Because the economy they're trying to control doesn't exist anymore. The 2025 economy is fundamentally different from the one in the textbooks. We're living in an era of structural inflation, driven not by temporary shocks, but by permanent shifts. Supply chains that were globalized for decades are now fragmenting. Geopolitical tensions are forcing countries to reshore manufacturing at higher costs. The workforce demographics have changed. Baby boomers are retiring, and there simply aren't enough workers to replace them at the same wages. Climate disasters are destroying crops and infrastructure with increasing frequency, adding cost pressures that never go away. And technology, which was supposed to make everything cheaper, is now concentrating wealth so dramatically that consumer behavior has fundamentally warped. The top 10% spend differently than the bottom 90%, and the Fed's tools can't distinguish between them. And here's what they're not saying out loud. The medicine became the poison. Every rate hike didn't just slow borrowing. It made the government's debt more expensive to service. And that debt? It's not just big anymore. It's existential. The United States is now paying over $1 trillion per year just in interest on the national debt. Not building roads. Not funding schools, just interest. And every time the Fed raises rates to fight inflation, that number grows. It's a trap, a fiscal cage with no exit. Think about what this means in practice. In 2020, when rates were near zero, the government could borrow almost for free. $1 trillion in debt cost maybe 10 or 15 billion a year to service. Manageable. But now? That same trillion costs 50 billion or more annually. Multiply that across 35 trillion in total debt, and you see the nightmare. The interest payments alone are now larger than the entire defense budget, larger than Medicare. They're approaching the cost of Social Security. And unlike those programs, you can't negotiate with interest payments. You can't reform them. You can't vote them away. They're automatic. They're mathematical. They're inevitable. And they grow exponentially if rates stay elevated. This creates a doom loop that few people understand. High rates were supposed to slow the economy and reduce inflation. But they also explode the deficit because of interest costs. A bigger deficit means the government has to borrow more. More borrowing means more bonds flooding the market. More bonds mean investors demand higher yields to buy them. Higher yields mean even more expensive debt service. And round it goes, a spiral that ends in either mass defaults, currency collapse, or the Fed stepping in to buy all that debt themselves, which is just inflation by another name. Then there's quantitative easing, the emergency tool that became permanent. After 2008, the Fed bought trillions in bonds to inject money into the system. It was supposed to be temporary. It never stopped. By 2020, the Fed's balance sheet had ballooned to nearly $9 trillion. They became the buyer of last resort, not just for government debt, but for the entire illusion of market stability. When they tried to reverse it in 2022 to shrink that balance sheet, markets convulsed. Liquidity dried up. Banks started failing. Silicon Valley Bank, Signature Bank, First Republic. The system had become addicted to Fed intervention, and withdrawal was catastrophic. But here's the deeper problem. Quantitative easing didn't just buy bonds, it rewrote the rules of capitalism itself. For decades, we believed that markets allocated capital efficiently. Good companies with strong fundamentals got funding. Bad companies failed. But QE destroyed that mechanism. When the Fed buys everything, price discovery disappears. Risk gets masked. Inefficient companies survive because money is free. Speculation becomes more profitable than innovation. Wealth concentrates at the top because asset owners benefit from inflated stock and real estate prices, while workers see their wages buy less and less. The Fed created a world where the stock market and the economy decoupled completely. Corporate profits soared while Main Street struggled. And now they can't undo it without collapsing the very markets they inflated. It's like they built a house of cards 50 stories high and they re-standing at the bottom, realizing that removing even one card brings the whole thing down. Now picture this. We're sitting on the largest mountain of debt in human history: corporate debt, household debt, government debt. All of it floating on a foundation of artificially low rates that lasted for over a decade. Entire business models were built on cheap money, zombie companies that only survive because they can refinance their debt at low rates. Private equity empires built on leverage. Real estate bubbles inflated by speculative borrowing. And now, with rates elevated, all of that is wobbling. The foundation is cracking. But the Fed can't lower rates without reigniting inflation. And they can't raise them without triggering a wave of defaults that would make 2008 look like a dress rehearsal. They're trying to put out a fire with gasoline. Here's the part that should terrify you. The next crisis won't be like the ones before. In 2008, the Fed had room to act. Rates were at 5%, they could cut them to zero. They could print money without immediate consequences because inflation was dormant. But today? Rates are already elevated, inflation is still a threat, and the Fed's balance sheet is bloated beyond recognition. When the next shock hits, and it will hit, whether it's a debt crisis, a geopolitical rupture, or a market panic, the Fed will have no ammunition left. They can't cut rates to zero again without destroying the dollar's credibility. They can't print another $5 trillion without hyperinflation becoming a real possibility. They're cornered, and the world knows it. That's why central banks are quietly buying gold at record levels. In 2023 and 2024, central banks purchased more gold than at any point in modern history. China, Russia, India, Turkey. They're all stockpiling physical gold as fast as they can mine and refine it. Why? Because they see what's coming. They're building lifeboats while the Titanic still looks unsinkable. That's why countries are exploring alternatives to the dollar for international trade. Saudi Arabia is now accepting yuan for oil sales, something that would have been unthinkable a decade ago. The BRICS nations are openly discussing a common currency to bypass dollar dominance. That's why Bitcoin and other decentralized assets are surging despite every attempt to regulate them into submission. The smart money isn't betting on the Fed anymore, they're betting against the system itself. They're preparing for a world where the rules change overnight, where the institutions we trusted become the institutions we fled from. Imagine this scenario: a major bank fails. Not a regional player, but a systemically important institution. Markets freeze. Credit stops flowing. The Fed steps in with emergency liquidity, but this time it doesn't work. Confidence doesn't return. Instead, investors start asking the question they've been too afraid to whisper. What if the Fed can't fix this anymore? Panic spreads. Bond yields spike. The government struggles to roll over its debt. Inflation surges as the currency loses trust. And suddenly, the tools that built the modern economy, interest rates, quantitative easing, central bank credibility, they all break at once. Let's walk through what those first 72 hours look like. Day 1. The bank stock is halted. Emergency meetings in Washington and New York. Reassurances are issued. The system is sound. Deposits are safe. We have the tools. Day 2. Contagion spreads. 3 more banks see deposit runs. Money market funds start breaking the buck, meaning they can't maintain their $1 share price. Corporations can't access commercial paper markets to fund their daily operations. Layoffs begin. Day 3. The Fed announces an emergency facility, unlimited liquidity for any qualifying institution. But the markets don't rally. They sell off harder. Because this time people realize that liquidity isn't the problem. Solvency is. Trust is. The entire architecture of modern finance is built on confidence. Confidence that your deposits are safe, that your bonds will be repaid, that the dollar in your pocket tomorrow will buy roughly what it buys today. And once that confidence breaks, no amount of Fed intervention can rebuild it quickly enough to stop the cascade. Now multiply that scenario across every sector. Commercial real estate, already struggling with empty office buildings and unsustainable debt, collapses. Pension funds holding those properties see their assets evaporate. Retirees who thought they were secure suddenly aren't. Credit card debt, auto loans, student loans, default rates spike as unemployment rises and credit tightens. Municipalities that borrowed heavily to fund infrastructure can't roll over their bonds. Basic services get cut. And through it all, the Fed is paralyzed, watching the machine they built dismantle itself piece by piece. This isn't fear-mongering. This is math. This is history. Every reserve currency in history has eventually collapsed under the weight of its own debt and the hubris of its central planners. The British pound, the Dutch guilder, the Roman denarius. They all believed they were different. They all believed their systems were too sophisticated to fail, until they did. The British pound dominated global trade for over a century. At its peak, the phrase, "the sun never sets on the British Empire," wasn't just propaganda. It was economic reality. And yet, by the mid-20th century, it was over. 2 world wars, unsustainable debt, and the rise of the American dollar ended British monetary hegemony. It didn't happen in a single dramatic crash. It was a slow, grinding decline. A series of devaluations, crises, and loss of confidence that took decades but felt inevitable in retrospect. The same pattern repeats throughout history. The Spanish Empire debased its currency to fund endless wars. The French livre collapsed under the weight of revolutionary spending. The Weimar Republic printed itself into hyperinflation so extreme that people burned money for heat because it was cheaper than buying firewood. Every single one thought they could manage it. Every single one had sophisticated economists and advisors explaining why this time is different. And every single one was wrong. What's coming isn't just another recession. It's not another crash that we'll recover from in a few years with some stimulus and optimism. What's coming is a systemic shift, a reordering of how money works, who controls it, and what it's actually worth. The Federal Reserve's magic trick is running out of time. The curtain is pulling back. And behind it, there's no wizard, just a machine that's been running on borrowed time and borrowed money for far too long. The question isn't whether the old system breaks. The question is, what happens the morning after it does? Who wins? Who loses? And are you prepared for the answer? History shows us that these transitions are never smooth. They're not managed declines where everyone adjusts gradually and rationally. They're chaotic, unpredictable, and violent, economically, socially, and sometimes literally. Savings evaporate. Pensions vanish. The rules that governed your financial life get rewritten overnight, but they also create opportunities. New systems emerge. New currencies gain trust. New institutions replace the ones that failed. The people who see it coming, who understand the transition and position themselves accordingly, don't just survive. They thrive. So what does that mean for you? It means the assumptions you've been taught about money are about to be tested like never before. That a diversified portfolio means stocks and bonds, that the dollar is stable, that the government can always step in and fix things, that retirement plans built on decades of compound growth in traditional markets will work out as planned. Every single one of those assumptions is built on a system that's currently fracturing. And when it breaks completely, the world will divide into 2 groups: those who understood what was happening and prepared, and those who trusted the experts right up until the moment the experts had no answers left. If you want to understand the collapse before it happens, stay here. Because what we discuss next will determine whether you see the future coming or get buried by it.